Steve Sosnick, who's the chief strategist at Interactive Brokers. He's joining in from London. Steve, the context is what I want to speak about. The ECB was the latest to talk about unwinding of easy monetary policy, moving away from negative rates. Is this the focus? Could you tell us which of the moving parts you're most focused on right now?
Good evening, and thank you for having me. Absolutely, I'm most focused on central bank movement because the reason we had the huge rallies that we did in most of the global markets was because of the record amounts of monetary stimuli, accompanied by huge amounts of fiscal stimulus in various countries like the US. Well, fiscal stimulus is largely done. There's still some working its way through the system in the form of infrastructure spending in the US, but I don't see us getting very much more. And the central banks have turned from incredibly accommodative to taking a negative stance, to taking a hawkish stance, but they haven't actually done very much yet in most cases. At the last Fed meeting, basically the Fed told us when they are going to start shrinking their balance sheet. They haven't actually done so yet. And really, we've seen 75 basis points in hikes, but that's from a ridiculously low number to a still quite low number. So yes, I think the markets have to stay focused on what the Fed, the ECB, the various global central banks are doing.
What's the possibility that you have a major impact even before the action, as you point out, which hasn't taken place yet, which starts on these major economies that forces central banks to say, you know what, we're going to hold off a little bit?
I think it's fairly high. And to some extent, I actually think that may be one of the goals of some of the central banks is I think they would rather tighten by using they'd rather tighten verbally than through actions. So remember, markets tend to anticipate events. So if the markets are fully anticipating or over anticipating the effects of the central banks, well, then maybe they don't have to do as much when the time comes. It does affect their credibility to some extent, but I think they would rather let the markets do the work for them than have to really be aggressive at tightening or raising rates.
And my final question, if you're looking at the US market right now, and you're looking at markets in Europe right now, how much of this is priced in?
I would say much of it, but not all of it. The problem is with monetary policy, it does tend to act with a lag. So even though I think markets are ahead of the central banks to some extent, that is one of the rare things that sort of markets wait and see. So I would say we still have some more to go. That doesn't mean we're not going to get rallies here and there. Sentiment is very bad right now. And when you have very poor sentiment or oversold conditions, you tend to get bounces. And in bad markets, actually, you get bigger bounces. But I think overall, we still have to at least see what happens once these policies really begin to be rolled out.
Thank you so much for taking the time. Appreciate it.